welcome. You've joined us on All About Your Company right here on ET Now. I'm Ashesha Advaryu, and today on the show we are going to put the spotlight on Equitas Small Finance Bank. And before we touch base with the management, we have financial trends and graphics that we need to put the spotlight on. The stock, of course, has been in focus for the last several months, and we barely get to interact with the management. And today we have the management here in the studios. But let's start with the financial history then. And as far as the profitability metrics is concerned, let's put the spotlight on that. The net interest income, we have seen a 3-year CAGR come in at about 10%. From about 2,500 crores in FY23, net interest income in FY26 stood at about 3,391 crores. 10% CAGR on the NII front is what we have seen over the last 4 years. Let's also put the spotlight on a couple of other metrics and the kind of performance the company has reported. The pre-provisioning operating profit, or PPOP as we call it, the three-year CAGR stands at 2%. And what led to this tepid growth, we'll talk to the management in just a bit. From about 1,180 crores in FY23, that now stands at about 1,265 crores in FY26. Shifting focus to a couple of other metrics then. This is the PPOP, or pre-provisioning operating profit. Provisions, meanwhile, have risen a whole lot. So from just about 370 crores in FY23, they came in at about 1140 crores in FY26. That's a growth of 46% on the provisioning front, but several factors were at play behind this increase in provisioning, and we'll discuss this with the management in just a bit. Other than that, let's also talk about a couple of other metrics then, especially the metrics that are relevant for a banking company, the profitability metrics. From about 574 crore of profit in FY23, it shot up to 800 crores in FY24, but it has declined a tad bit. But as I mentioned, the company is working. It's a turnaround story. Several factors are at play, because of which profitability has come in at about 103 crores in FY26. So that's the profitability metric for you for Equitas Small Finance Bank. Let's also talk about a few other parameters which continue to remain at play. And the advances growth at about 18% CAGR from 28,000 crore in FY23, it has risen to about 46,000 crores at the end of FY26. So clearly 18% is the advances CAGR growth that we have seen over the last 4 years. Let's also talk about a couple of other metrics which continue to remain at play, and deposits. That's another important metric for a banking company. We have seen a CAGR of about 22% versus the advances figure that we just spoke about. From 25,400 crore in FY23, advances have now risen, or rather deposits have now risen to 46,500 crore. 22% CAGR as far as the deposit growth is concerned. Now remember, the company is also focusing on increasing its advances base. It is getting into several other segments. It is increasing its focus on vehicle and gold financing as well, and we'll talk about that in just a bit. But this is the deposit growth for you, 3-year CAGR, which came in at 22%. Let's also talk about a couple of other metrics then, and the CASA deposits. They stood at 10,700 crores in FY23 with a 3-year CAGR of 4%. They now came in at about 12,200 crores. Let's also talk about a couple of other metrics, the net interest margin, and that clearly is the most important metric for a company like this. From 9% in FY23, net interest margins have come in at about 6.6% in FY26. So there is some bit of moderation as far as net interest margins are concerned. What led to that, and what is the outlook looking like? Remember, the management has also given the guidance for a second quarter and for full year FY27 as far as net interest margins are concerned, and we are going to discuss that in greater detail in just some time. Let's also put the spotlight on return ratios then, and return on equity in particular should also come up for you on your screens. Return on equity from about 7.75% in FY22 has fallen a tad bit to come in at 1.7% in FY26. Meanwhile, as far as analyst recommendations are concerned, 24 analysts have a buy rating on Equitas Small Finance Bank. 1 analyst has a sell rating, and return potential stands at about 17%. So analysts see nearly 17% upside on this counter from the current market price, but 24 analysts have a buy rating on this counter. As far as valuations are concerned, it trades at about 1.4 times. That's the current price to book for this company. versus 1.2 times. That's the 1 year forward price to book ratio. So that's the valuation picture up for you on your screens. The current price to book at about 1.4 times. Let's also talk about a couple of other metrics then, and let's talk about advances growth. As I mentioned, the management has given advances growth guidance for the next few years. They've spoken about 20% plus growth. Is this conservative? Is it ambitious? That's another important question to get answers to. FY27 return on asset, earlier guidance was 1.2%, and now it is expected to remain in that 1.2, 1.3% mark. So we'll talk about that as well. And FY28 return on asset, meanwhile, is expected to improve as compared to FY27. So that's another important metric that we have to talk about. Meanwhile, let's also talk about gross advances. They crossed that 47,000 crore mark in the first quarter of FY27. And for the full year, we are expecting 27% growth as far as gross advances are concerned. So these are several factors which continue to remain at play for this company. But we will also have the managing director and CEO of the company, Mr. P.N. Vasudevan. We'll talk to the management in just a bit after this very short break. Welcome back. You're still tuned into All About Your Company right here on ET Now. And Equitas Small Finance Bank is on our radar this afternoon, and we are in conversation with the management. The MD and CEO of the company, Mr. P.N. Vasudevan, is now joining us. Thank you for taking your time out and joining us here in our Mumbai studios. And let's start by talking about advances growth. 20% is the guidance that you've given for this year. I was just talking to the sector researcher, and he was telling that this is a little cautious because you've registered much higher advances growth in the past. What will your view be on this?
See, we became a bank 10 years back. And in the last 10 years, if you see our CAGR, advances growth, is about 26%. So that way, the expectation is that we may be able to do around that. But last year, our growth was 18%. You know, last 2 years, we have had some issue in the microfinance sector. And so our growth tapered down a bit in the last 2 years. So we are giving a cautious guidance of 20% for this year. However, the first quarter, we ended up with a 28% growth. So we believe that for the entire year, we should be able to do more than 20%. But at the end of second quarter, we'll review. And then maybe we'll come with a revised guidance after that.
Okay, so we can safely say that it is going to be more than 20%. Are we getting it right?
Yeah, absolutely. I think 20% plus is given. How much we'll do beyond 20% is something we'll probably guide post the second quarter.
And what about FY28 then?
See, if you look at our history, consistently our growth is over 25% over the last so many years. So on a medium-term basis, you know, rather than talking of a specific year, on a medium-term basis, let's say over the next 3 to 5 years, we should be able to look at anywhere around the 20% plus level.
And what are the segments that will drive this growth? I believe you are increasing your focus on vehicle financing, on gold financing. What are those pockets that will drive higher growth?
See, 40% of our loan comes from small business loans.
Correct.
These are business loans given to small businesses which are secured by their house property. That is 40%. And that's one of our flagship programs, and its credit cost is around 0.6% over the last 5 years. The second major contributor is commercial vehicle finance, where our focus largely is on the used commercial vehicle and the used car segment. That's contributing about 25% to the portfolio. And the average credit cost there is slightly higher because it's a used commercial vehicle. The risk is always higher.
Correct.
So our credit cost will be in the range of 2 to 2.2%. That's about 25% contribution to the book. The third is our affordable housing, which is a 13% contribution to the book. There the credit cost is generally very low. It's in the range of 0.2 to 0.3%. And then comes microfinance. And that's our real, rabbit in the hat, so to say.
Correct.
It's currently 10%. It was 20% 2 years back. And when the MFI ran into some crisis, we
Correct.
also actually suffered. And if you've seen the data that you have just presented just before now, you would see that while we did very well in 22, 23 and 23,
Correct.
24, there is a steep drop
Correct.
in 24, 25 and 25, 26. Largely contributed by provisions from microfinance.
Correct.
But now hopefully, thankfully microfinance troubles are behind not only us but behind the industry.
Correct.
And so this year we expect microfinance to also contribute positively to the bottom line.
And as a percentage of total mix, is the share from MFI likely to go down further from 10% currently?
No, we plan to keep it at around the 10% level.
Okay.
We were at 20% last year, 2 years back. We have brought it down to 10. our projection is that we'll keep it around the 10%. And we have introduced two new products, which is a credit card and a personal loan. They've just started. Over the next 3 to 4 years, we expect credit card and PL to contribute about 5%.
Okay.
So the overall unsecured book for Equitas over the medium term of 4 to 5 years, we should expect it to be around the 15% level, remaining 85% being the secured loans.
Okay, and Mr. Vasudevan, you also cater to segments which have high risk inherently. How do you aim to mitigate those risks?
See, basically we focus on the informal to semi-formal category of borrowers. Okay. Now in that segment, if you see, the unmet credit demand is something like 85 lakh crores. It's a very huge amount of unmet credit demand, be it affordable housing or the small business loan or the used commercial vehicle, etc. And the financial inclusion efforts of the government and RBI, which has been going on for quite a long time now, has been denting that the unserved market has been dented over a period of time. Still, the unmet demand still remains very, very large. And Equitas is focused on that segment. The risk is not so much because the customer is bad. It's not that the risk of the customer is bad. It is just that it's difficult to understand his credit profile and understand this cash flow, the amount of cash flow that he generates. It's difficult to understand. But if you spend that extra time to understand, then it is not that risky a business. And our own credit cost on an average, if you remove the aberrations because of microfinance, otherwise our credit cost has always been in the range of 1.25 to 1.3%. Which is really par for the course, given the fact that we are lending to a highly underserved segment.
Right, and that brings me to the next question. What about cost of funds and its impact on net interest margin trajectory going forward? I believe you've already given a guidance for the second quarter as far as NIMs are concerned, and we're expecting some bit of contraction. What will the trajectory look like after the second quarter?
So we have recently increased our rates on SA, some slabs of SA, and also some slabs of TD. So that was done about 3 to 4 months back. So we expect some marginal increase in the cost of funds. The second quarter cost of funds was 7.05. We expect that to maybe become 7.15. About a 10 basis points increase is what we expect in the cost of funds. NIM was 7.24% in the first quarter. Over the rest of the year, it might trim down to 7.1 or around that 7.1 level. But proportionate to the drop in that NIM, we also expect two other things to happen. One is our cost to assets. Even in the slide that you showed a little earlier, our cost to asset has been coming down. And we expect that slide to continue, so that 15 bips drop in NIM to some extent should be offset by the cost to asset also dropping. And second thing is our credit cost. The first quarter credit cost was 1.36%, and traditionally first quarter is the weakest quarter for most of us in the industry. And our credit cost was 1.36. Second quarter, we expect it to be close to that. Maybe marginally it may be less. But third and fourth quarter, we expect the credit cost to be significantly lower because they are the best quarters for us normally. So overall, the credit cost may drop
in the second and third and the fourth quarter.
Third and fourth quarter, and the cost to asset drop. These two we expect to overcome the NIM drop.
Okay, and how will advances growth versus deposit growth be going forward? What will the differential be, and how do you aim to marry that?
Yeah, so deposit growth, we had only a 10% growth in the first quarter against a 28% growth in advances. So obviously deposit needs to pick up. So a lot of efforts have been done. There's been restructuring in the liability division. We have created some 3 new verticals within the division to get more focus on CASA and TD. And actually, if you see the history, in your own slides also, our last 4-year deposit growth was 22%. So historically, our deposit growth has always been very strong. Last 1 year is where our deposit growth has slowed down. We consciously slowed it down because our advances growth was only 17-18% last year. So we actually slowed it down. Now advances has picked up, so we are now pushing the envelope on the deposit growth also. And to support that, we did increase the rates in SA and TD a little bit in the last 2-3 months. And so we expect the traction on deposit to come back. If advances grows by, let's say, 25%, for example, we would expect deposit to also catch up around the same level.
Okay, and since we are talking about deposit growth, let's also talk about FCNR mobilization. Is it likely to aid, and what is the kind of mobilization that we have seen of late?
Yeah, the FCNR has been doing really well for us. Over the last about a year and a half, when we launched FCNRB, we have mobilized about 35 million US dollars. When the RBI announced this swap window for a 3-month period, in 3 months we were planning to double our FCNR from 35 million to 70 million. But in the first 2 months, or 1.5 months actually, our FCNR from 35 has already come to almost 60 million. So more than our projection, we expect the FCNR to really go up. And we still have about a month and a half.
Correct.
So instead of 70 million, we are hoping to push it somewhere closer to the 90 to 100 million.
Okay.
And this is without leverage. This is absolutely direct mobilization from our clients. We cannot offer leverage because I don't have a foreign branch.
Correct.
So I can't offer a leverage. We are in discussion with some foreign banks and some Indian banks for giving us a SBLC, some standby line of credit, against which we are trying to get a leverage limit from foreign banks. That effort is going on parallelly, but even if that doesn't come through or takes its own time, our direct mobilization has done really well. And so against the 70 million target that we kept for ourselves, we are hoping it will be closer to 90+ million.
Okay, so that's as far as FCNR mobilization is concerned. But on that note, we need to slip into a very short break. We'll continue our conversation with the management of Equitas Small Finance Bank in just a minute. Welcome back. You're still tuned in to All About Your Company on ET Now, and we are in conversation with the management of Equitas Small Finance Bank. Mr. Vasudevan, let's also talk about asset quality. We did talk about advances and deposit growth before the break, but asset quality, if you look at the trend over the last few quarters and even years for that matter, we've seen a deteriorating trend. If you can take us through what went wrong over the last few quarters and what's the outlook now that you have changed your advances mix, is it likely to improve going forward?
Yeah, so if you see the last 5-year trend, our credit cost has been in the range of 1.2 to 1.3%, 3 to 4 years back. The last 2 years, that is 24, 25 and 25, 26, our credit cost actually shot up closer to about 3.5% plus. The reason is because of the microfinance issue that all of us have been struggling with over the last 2 years. The entire microfinance industry was highly over leveraged. And just to give you a few data points, the microfinance industry in March 24 was 4.6 lakh crores. And in March 26, it's actually come down to 3.4 lakh crores. So almost a 25% drop in the industry exposure for the last 2 years, showing that that was the probable over-leveraged quantum in the microfinance market. With that deleveraging happening in the market, that's why we are seeing the trend of microfinance portfolio coming back to shape, and good quality is now something that is playing out right now.
Correct.
So because of that, we had that issue. But with that behind us, this year, we have guided for a 1.5% credit cost. But as I mentioned a little earlier, first quarter was 1.36, and going forward it is only expected to reduce. So we expect a lower than 1.36% credit cost for the rest of the year.
And how do you expect the the GNPA and NNPA numbers to be going forward?
So our GNPA first quarter was 2.4% and NNPA was 0.7%. By and large, we expect it to remain within that range. Maybe a few basis points it may come down or whatever, but we largely expect it to remain flat.
Okay, and let's also talk about the universal banking license that you've always aimed for. Now, what is the aspiration and how do you aim to achieve the targets that are needed to meet to be able to eligible and become applicable for that license? So
RBI has given a set of guidelines for conversion of SFBs into universal bank. When you look at the objective numbers given in that guideline and plot our own numbers against that, it looks like we do qualify.
Okay.
It looks like we do qualify under those parameters.
Okay.
And so we may be eligible to apply.
Okay. And will you be applying? That's the bigger question.
Yeah, so, but then there is something beyond just numbers.
Correct.
Right? When RBI looks at converting an SFB into a universal bank, surely they will be looking at the numbers will be the one focus area.
Correct.
But beyond the numbers also, there will be other softer aspects and elements that they will be looking at. So obviously, no one is privy to that part of what RBI will be looking at. So we are in dialogue with RBI. And we are not in a hurry. We don't want to rush up and file our application. and for any reason we don't want it to come back.
Correct.
So we'll take our time, we'll study our own financials, our own qualifying criteria, and once we are comfortable and confident, we'll reach out to RBI and take their guidance whether they think that broadly we look okay to apply. So we'll get some kind of comfort from both our board and from RBI.
Correct.
And basis that we'll end up applying.
But realistically, how soon is that possible? Is it likely to happen in the next 4 to 6 months?
Well, I can't put a timeline around it, but we are working at it.
Okay, working. I think we can conclude that it is on the table and perhaps it could come soon. Let's also talk about fundraising, and the board has already approved 1,250 crore of fundraise. To be able to meet your advances guidance that you've just shared with us, 20% for this year, will you need additional capital?
So our capital adequacy in the first quarter was 20%, slightly over 20%, which is very comfortable. Actually, we don't have much of an issue from a capital adequacy perspective at this point in time, and there is no requirement to raise capital immediately. But we have taken a board approval, and in the upcoming AGM, we'll be taking it, putting it to the shareholder for approval. This is basically an enabling provision.
Correct.
We'll keep that ability to raise capital as and when required. What we believe is that for this calendar year, we may not be required to raise the capital. Sometime in the fourth quarter of this year, or maybe the first or second quarter of next year, is when we probably may look to raise the capital. That all depends on how much of growth we are able to put up and what's the amount of capital that we consume. There are a lot of instruments for capital preservation, which we are also working on. Like we raised 1,000 crores of Tier 2 last year. This year we are planning to raise another 500 crores, and also there's some amount of guarantee schemes that are available with the government. So some of our portfolio we are giving it under the guarantee scheme, so again capital gets released. So there's a lot of instruments to preserve capital. So we are working on all of that, and we will try and postpone the capital raise for funding the growth to probably the first quarter of next year or somewhere around that range.
Okay, not immediately, but somewhere down the line, a fundraising might be required. Mr. Vasudevan, unfortunately, you have to stay on with us. We need to take one more mandatory break, but we'll be back in a minute. Welcome back. You're still tuned into All About Your Company right here on ET Now, and we're in conversation with the management of Equitas Small Finance Bank, and we were talking about universal banking license. We did discuss the fact that the business that you are in has risk, but they are also higher yielding in terms of net interest margins. What will the trajectory look like some years down the line? We did talk about FY27, but what beyond that? Since the entire portfolio has now undergone a change with the MFI change that you just spoke about, what will the trajectory look like for net interest margins over the longer period?
So as I mentioned, this year we expect to end the year at around 7.1% NIM. In a medium term, let's say 3 to 5 years from now, given our product mix, and we don't see any dramatic change in the product mix, most of the products that we want to do are already in place, and our product platform is quite stable now, and we are only going to build on top of that. So our expectation is that in the medium term, our NIM should be around that 7% level on an ongoing basis.
Okay, and as far as vehicle financing and gold financing is concerned, what are the risks that you're building into these segments?
See, in vehicles, as I mentioned, it's a used commercial that we largely focus on, and then the used cars.
Correct.
Used car is a consumption product, so we generally don't see much of an issue in that. But used commercial vehicle is a commercial product, and it's linked to the economy. And so whenever the economy does well, the used commercial will do well. And if the economy has any issue, then used commercial will reflect that stress. As of now, we see the used commercial holding up in spite of the oil shock that we have been experiencing. We are seeing the used commercial market really holding up. And recently, in the last about a month or so, we had a few state associations of lorry transport associations where they have increased the freight rates within their states to offset the increase in the oil price. So I think by and large, our people are able to manage the increased oil cost by a little bit of a support from the fuel, from the freight rate increases.
Right. And since we've had a detailed conversation, if you had to give one takeaway to your investors who are listening to you right now, what will the 3 to 5 year strategic roadmap for the company look like?
So we had an investor day meeting on 11th of June this year, and we have set out our 5-year vision in that document. So we are saying that from 47,000 crore of advances, in 5 years we expect to cross 1.2 lakh crores
Correct.
of advances. That's what we expect to cross. Deposit growth should be in line to support that kind of an asset growth. And we are talking of a steady state 1.5 plus percent of ROA. In good times, it can go to 1.8. In bad times, it may come to 1 to 1.25. But otherwise, on an average basis, it should be around that 1.5% plus level. So that's what we are looking at, and that's what we are guiding over a 5-year period.
That's the 5-year roadmap. But all the very best, and congratulations on the kind of turnaround and the rejig that you've done to your portfolio. Mr. Vasudevan, thank you so much for taking your time out and joining us here on an ET Now Studios.
Thank you so much.
And with that, it's a wrap on this edition of the show. Thanks so much for tuning in. More news and updates will continue on the other side.